Welcome back. Let's take another caller right now. Lucy in Toronto, go ahead.
Thank you, Catherine. David, please let me know your opinion on Linamar. It seems like a good entry point right now, or is it wiser to avoid that whole sector? Thank you.
It's a great question. So the auto sector is a sector that really had a great run leading up to October of last year, and Linamar, one of the leading stocks. I think that there's a real split opinion on auto right now, and there is a view that we may have seen sort of peak demand, and that the units could come off over the near term. I don't share that view. That being said, technically, Linamar is not behaving well. And I go back to the fact that you only need so many great companies in a portfolio. Auto in general is not behaving very well. Magna not so well either. So I think I would avoid this group. Now, one of the top picks we're going to talk about tonight is have a market-leading position in supplying into auto. So I'll leave you with that and hopefully fill you in later.
Okay. The one thing I would just say with respect to auto stocks and auto parts makers, it's almost like, or it reminds me going back at least 10 years ago or so, when you see auto sales peak, these stocks really struggle to perform. It's just like energy. If the commodity price is down, the energy stocks have a very, very tough time to outperform the direction of the price of crude. So it seems so similar, and we forget that because the performance has been so strong lately and the auto sales have surpassed everybody's expectations. Right. We're almost forgetting the past, aren't we?
And I think that's the thing. I mean, they call these stocks cyclical for a reason. Now, having said that, I'm not ready to write an obituary on the U.S. consumer. In fact, I think that they're going to look pretty good for a long period of time. But I can't fight the market's view. And I'm not going to say the market's wrong. I'll wait to see the share price performance, mirror my view before I'm going to put positions on.
Okay, so it sounds like maybe a little bit of a wait approach, Lucy. Let's take another caller right now. Stephen in Oshawa, Ontario. Go ahead.
The question is on Disney. I wanted to know your relative outlook for 2016. I know the PE ratio is relatively high. And what is your outcast and forecast for the rest of the year? Thank you. Okay.
So I really like consumer discretionary. We believe that if the price of energy was to remain low, which we believe that it likely does, and plentiful, that's great for developed consumer-led markets like the U.S. Disney, of course, is right dead center of travel and leisure. So it's great for that. Their theme parks doing very, very well. Their entertainment, the movies doing very well. The thorn in their side is ESPN. And ESPN has been a great growth engine for them, and their subscribership is under a little bit of pressure there. So I'm going to say they're likely to get over that. The stock has made a nice turn, and consumer discretionary in the last week has really started to pick up. I think it's a great company, so I would consider owning this one. We have a small position at the firm, and if it can trade through sort of 105, 106, 107, technically it gets a lot better, and I'd probably add to the position there.
Okay, let's take another caller right now. Larry in Toronto, go ahead.
Taking my call. I'd like to ask Mr. Burrows' opinion on GlaxoSmithKline. I sort of have had it for about 18 months. It's been good to me, and bought it under $40, and it's like the Johnson & Johnson of Europe. But I'll hang up and listen to Mr. Burrows' comments.
Great.
Thank you.
So, Larry, congratulations. That's a great entry point. Okay, so Glaxo, 5.5% dividend. Nothing to sneeze at there. Pharmaceutical relative to biotech seems to be improving, so I like the pharma space. I really like Bristol Myers because their growth rate is just a little bit higher, but I wouldn't be negative on owning GlaxoSmithKline.
Okay.
So I think I like the whole group for a small position, and GlaxoSmithKline fits in there.
Why just a small position?
Well, because within healthcare has lagged a little bit. There are political concerns, right, around pricing. Hillary Clinton is not likely to go silent on drug pricing, so this is going to be a political football through the election. When I look at healthcare, medical devices have been performing much better, so I prefer that space. But I think that it's a great dividend yield, and you're going to get dividend growth. So if you're okay with not having something that's very economically sensitive, you might not do quite as well, but you're going to have a consistent return.
Okay, we're going to be back with David Burrows. He is President and Chief Investment Strategist at Barometer Capital Management. Answering your questions about North American large cap companies, you can call us toll free, 1-855-326-6266.